all know that realty income, not reality, has been the model REIT specializing in commercial properties since it IPO'd in 1994. Its 15% annualized returns since then is boosted by the fact that they have been paying increased monthly dividends for over 25 years. But what if I told you that there is a chance to get in on yet another monthly paying dividend REIT poised for greatness, and it's still in its early stages? Today we're going to be talking all about STAG Industrial, a company that was only founded in 2010 but already has a valuation of $7 billion. STAG, unlike realty, is focused on single-tenant industrial properties in the United States. Currently, their portfolio has 501 different buildings, making up over 100 million square feet in 39 different states. Let's talk about what the industrial space sector is. This is the buildings that are used for manufacturing, production, fabrication, and assembling of products. This could also include warehouses. So yes, this isn't the nice beachfront property like residential real estate, but industrial real estate is vital to the economy. It's also a great investment because of stable cash flows, and tenants, they tend to sign up for long-term leases. This could also potentially mean less maintenance costs, and that means less tenant turnover. Did I mention yet that STAG has the majority of its tenants under triple net leases, meaning it's the tenant who is responsible for all costs related to the building, like utilities, property taxes, insurance, etc. This is an industry that is going to be hot in demand as the rise of e-commerce needs the place to be executed. As our economy continues to grow, so will the demand for STAG, as we are currently going through a massive worldwide supply chain crisis. After C-19, there is more of a push to have manufacturing come back, at least on a small scale, back to the United States. And I cannot see the US being so behind on having medical supplies during the next pandemic.
Deal with, and the one that was underway when I took office. You know, we have roughly 350 million people vaccinated in the United States and billions around the world.
Well, actually, maybe I could. The global e-commerce revenues are expected to be over $2.7 trillion this year, and they are projected for roughly 11% year-over-year growth until 2025. This is a company that can provide not only consistent monthly dividends, but also great capital appreciation. Just look at the growth of STAG since they IPO'd in 2011. Their square feet went from 14 million to 100 million. They are also up from 93 properties now to 501 properties. Also going up was the number of states that they are found in, going from 26 states to 39 states. In the past 6 years, they have averaged over $700 million in acquisitions, but that number is expected to reach up to $1.2 billion in acquisitions over the next 5 years, according to their latest guidance. There is also a large target market for industrials, as the market size is over $1 trillion, and this is a sector that is needed in every part of the world. In the MGM growth properties video that I did, which is now going to be part of Vici, much of the entertainment was really heavily skewed toward Las Vegas. The same rules do not apply here. STAG's portfolio is also quite diversified. They're located in over 60 different markets, and they have exposure to 45 different industries. Their largest tenant is only 4% of their rents, so in case something bad happened to them, they're still covered very easily. Also with real estate, this is all contractual rent. Over 70% of their leases are beyond 2023. Let's take a look at some of their top tenants. You may have heard of this company called Amazon, which is slowly taking over every appliance in your room. They're the largest tenant at 4%. XPO Logistics is a freight transportation company at 1.2% of their portfolio. You've heard of FedEx, and you've also heard of Ford Motor Company. They round out the top 10 of their biggest tenants. 61% of their tenants have revenues of over $1 billion. So again, this really just showcases that this company is well diversified across many different industries, geographical locations, tenants, and they also have very long contractual lease agreements. According to their latest earnings call, the company is not slowing down anytime soon, with plenty of acquisitions in the pipeline. So far in 2021, they've already acquired 15 new buildings for 2.6 million in square feet, with the average length of leases at 7 years. It's going to give a return of about 5.8% as its cash cap rate. Now that is a little bit lower than I would typically want. Typically I look for about an 8% cap rate. That would be the lower bound of what I'd consider a good return, but each sector of real estate is going to be different and have its own good rates. When we look at their financials, we can see that STAG's funds from operations has continued to rise, going from 137 million in 2016 to 297 million last year. To have a 22% year-over-year growth during a recession is quite impressive, and that really shows the resiliency of this company. Something else that dividend investors will love is that their dividends paid has also increased over the years. However, it's not always in the way that you would think. October of 2013 was the very first time that they started paying monthly dividends. Prior to this, it was always on a quarterly basis. Since then, though, it has only raised the dividend a fraction of a penny each year since. Its 5-year dividend growth rate is an abysmal 0.85 basis points. That is among the lowest I have ever seen a company have. That's even lower than Verizon, and nobody has a lower dividend growth rate than Verizon. But STAG still does have a very impressive around a 3.5% dividend yield, and they have also never missed a monthly dividend payment. Getting dividends paid every single month allows us to cash flow quicker and just makes the compounding happen that much quicker. I do want to add something slightly concerning, and that is the aspect that STAG is issuing new shares quite often. It has a 25% CAGR since its IPO in 2011, going from just 16 million shares outstanding to now well over 162 million shares outstanding. Now this isn't unusual for REITs, as they do issue new shares to be able to fund acquisitions, and hopefully that will allow STAG to continue to grow. If the dividends and share dilution disappointed you, let's switch to a high note and note that STAG has actually outpaced the S&P 500 over the last 10 years, giving us a total return of around 19.4% annually compared to just 14.8% annually from the S&P 500. That means a $10,000 investment 10 years ago would now be worth over $63,000 compared to the S&P 500's just $42,000 in that same time span. Now the only thing giving a better return is hitting that like button and subscribing to the channel, as these videos do take a lot of time for me to research and edit. Make sure you check out the Collect Cash podcast wherever you get your podcast. And I'd love to hear what your opinion on STAG is. Is this monthly dividend stock just as good as Realty Income? Does it get any better than buying, stashing, and collecting cash?